Okay, hello and welcome everybody. Our next talk is going to be by Dr. Vesna Strasser. She is the Director of Trading Analytics at Liquid Matrix, and she's an optimal trade execution algorithmic trading consultant. She's going to be giving a talk titled From Backtesting to Live Trading. Please welcome Dr. Strasser.
Well, thanks everybody for coming at this late hour. I guess there's one more talk to go, and then the fun part begins. So today I'm going to be talking about the execution side of the investing story. I think most of the talks you have listened today were focusing on various investment strategies and alpha ideas, but at this particular time we're going to be talking about the execution side. I think the execution side is oftentimes as maybe underrepresented or underestimated, right? Oftentimes we have customers that say, well, my strategy did so well in backtesting, I did the auto sample testing, everything looked fine, and then went to live trading, and suddenly the alpha is no longer there, and sometimes is so small or even negative. So what we like to focus here that on this talk today is really discussing what we need to keep an eye on when we're designing a trading system. And once you go to execution, the parameters that come into play are much broader than what we're using in backtesting. So first, I'd like to address the kind of the process of designing a trading system. First, we'll be talking about the idea. We develop the model. We go into the various alpha ideas. When we're happy with what the model is showing us, we start backtesting. In backtesting, typically, what we mean here is we're conducting out-of-sample testing. We're checking for various data consistency and working with very simplified data. The idea is to be able to run a lot of simulations, backtesting simulation, in a fair amount of short time to see the model is valid. Once we're happy with the result, what I call, for this particular two steps, I call this the model testing phase. When we're happy with the results of the back testing, typically the next step would be to do simulation trading. By simulation trading, we mean paper trading. We basically assume that signals and is generated in real time using real-time data. Basically, we're using all the data available in real-time trading. However, when the orders get filled, we need to assume certain prices, certain fill rates, and certain trades cost assumptions. So it's very similar to live trading, but it's not really because the executions are actually assumed. This simulation trading in many ways is dependent on what type of simulator you're using, and ideally you would be using simulator that mirrors your trading strategy in a very close way. Once we're happy with simulation trading, then we go to live trading. Live trading, again, we're still using the same data we use in simulation trading. However, orders actually get filled based on the real-time market dynamics, which can be different from what the simulator is using. So when in the process of strategy design, we kind of be mindful of these possible differences between these three systems that can result in quite different execution performance. So the topic of this talk will be focusing on this execution testing phase, figuring out how to minimize the differences between these three stages so that our live trading results are as close to backtesting as possible. So in the basically trade process, the way I see it, can be divided then into two different phases, or it can be driven by two sets of factors. One is the trade model design phase, where we're deciding what and how much to trade, and then we're moving into the trade execution space, where we're deciding how to trade, basically how orders get filled, at what prices get filled, at what times, at what size, what particular exchange, right? So these execution parameters can be sometimes responsible for quite substantial differences with what we see in the backtesting. So it's very important that we understand what drives those differences and address them in all phases of trade design process. I also like to emphasize that, and then we're going to be discussing this later anyway in more depth, that high turnover strategies that high frequency or maybe intraday strategies are much more susceptible to these discrepancies than low turnover strategies. So what are the execution factors that driving performance delta between our backtesting results and live trading? First is the data structure. And I like to specify here that there are many vendors in the space, right? Or you may, if it's a prop trading shop, they may develop their own backtesting simulation environments. But there are many vendors in this space, and there are significant differences between vendors in terms of what kind of customizability and flexibility they're allowing you in your backtesting and simulation environments. So it's very important that you're aware of these differences and that you try to pick a vendor that would kind of most closely match to what you your training style. So first, there's a big difference in that typically with in the data structure, right? In the backtesting, typically we are working with the sample data, with open, high, low, closed data built from the actual trading data. Some vendors may allow you some more flexibility, may allow you VWAP prices or rival prices, but typically it's just the open, high, low, closed prices. And I think the Quantopian platform, this is the data you're working with, right? It may be sampled different frequencies, a minute, 10 minutes, 15 minutes, but ultimately it's not the real-time tick data. In simulation trading, we are working with the bar and with the tick data most of the time. So signal and fills are basically processed in real-time tick data. This data can be either replayed or you can do it in real time, but ultimately you taking into account almost every price move and quote move. And in addition, you're taking into account, the system should be taking into account market depth data, which is level 2. In live trading, we are working with live tick data, level 1 and level 2. So we already start with the data differences, so clearly that's going to lead to some differences in the trading performance. In backtesting, signal is calculated at the end of the bar, typically, right? So you basically can have one trade per bar. Some systems they will allow you some flexibility, but most of the time you have one trade in bar. In simulation and in live trading, trades are generated, signals processed on every tick, so you can have many more signals generated than you can have in backtesting, and that would lead into different trade counts. Fill price, in backtesting, we are assuming fixed trade price. Can be either open, high, low, close against maybe VWAP, maybe some average price. In simulation trading, trade price is simulated. And in live trading, trade price is actual trade price that you get, and it's market-driven, a price you get from the market. Fill rate, typically in backtesting, we always assume orders get done with 100%. In simulation trading and live trading, that is different, right? In simulation trading, typically, if you have a good simulator, your order may not fill 100%. Also depends on the order type. And in live trading, partial fills are much more common than full fills, especially if the order sizes are large. So here, again, potential for big differences. In backtesting, transaction cost is a component that typically is used or not really applied in backtesting. If it is applied, it's some fixed cost that is very simplified, but at least if it's taken into account, it's already a step better than nothing. In simulation trading, various platforms are allowing various transaction cost model, can be flexible, some can be more static, some more order driven, but it's probably more refined about what's used in backtesting, which is a good thing. And in live trading, of course, market impact transaction cost is market driven. Trade count is another source of differences. In backtesting, as we already mentioned, because of the data structure we're typically using, we have one trade per bar. And in simulation trading, we can have as many trades as more trades, right? Depending on how prices are moving in a particular time, how many times the signal is true. And in live trading, we can have yet a different number of trade counts because the prices are moving up and down. They can move quickly. Sometimes we may miss a trade. Sometimes the latency is preventing us from getting executed, so we can have different trade counts in different environments, leading to different trading performance. Latency is another category that is typically not included at all in backtesting, right? Because it's a very simplified environment designed to get results faster. In simulation trading, typically the only latency we can account for is network latency, or typically is basically how quickly our computer is connecting to the simulation network that we are using. In live trading, we have various kinds of latencies that can have significant impact, especially in fast trading, high liquid equities. So something that we kind of want to keep in mind when when we're moving from backtesting to live trading. All of these parameters depend on what the strategy type you're using and what is the holding time of the strategy. The higher frequency strategy, more important these factors will be. And again, different vendors provide different flexibility, so there can be fair amount of differences between different vendors using when we are accounting for these particular factors. So it's just, I guess the idea is good to be aware of them. Let's look at an example. I put together a very simple mean reversion system. It's trading a 10-minute signal. Is using trading on 10-minute time interval. If the price is below the mean, we are buying, selling when it gets back to the mean, and other way around. So I have created here again very simple system, and we ran it on a day of trading, where we see already within one day we got quite a bit of differences in the results, right? In our backtesting, P&L is higher than in our simulation trading. Then we also have different number of trades in the different environments, precisely because in backtesting we're assuming fixed prices and fixed relationships, while in real-time trading things are moving dynamically and the signals may not be true as they are in backtesting. And also we can see in the last two cases here that the trades were executed at different times, meaning exited in different times. So these are all kind of manifestations of how different the environment is from backtesting and simulation trading. So it's really critical to put together a strategy in a way that accounts for these possibilities. So moving on to the kind of a source of these differences, kind of looking in more depth, like zooming into these particular differences. So here we are comparing the price slippage between these three different environments. And what we have here is hypothetical price movement in a black line and some bar data, which is what typically the backtesting environment would make you available, which is open prices, low prices, high, and close prices. So at the blue line, signal is true. And in order for when we looking at doing our analysis in a modeling stage, right, we are looking at the decision price, and we are looking at the decision price. This is our theoretical price, and ideally we would like to execute trade at this price. In actual trading, we may actually get the worst price, which is the blue price, right? And the yellow one is the simulation price, again, different from the actual price. In a backtesting environment, typically backtesting is assuming that if the signal is true now, we're going to be either executing the open of the next bar or the close of the next bar, which in backtesting would generate yet different price slippage notated in kind of an orange, dark orange, and light orange bar color. So basically what we're demonstrating here, you can have four different slippages, right? One is the actual slippage, one is the simulation slippage, and one is the backtesting, and two different backtesting slippages depending on what kind of price you assumed in backtesting environment. And how does this translate into the P&L? It's getting a little fuzzy, I understand that, but hopefully the colors are helping to kind of denote the differences. So the idea here is that we're not only just looking at the entry signal, we're also looking at the exit signal, right? We're calculating P&L difference between the exit price and the entry price. Again, the blue, light blue, that indicates the decision price, which is the time that, in our models, this is where we're going to be entering the trade. And the red one denotes the exit signal is true. So in theoretical performance, a true P&L, not true P&L, but like a theoretical P&L would be the difference between these two bars, which is indicated by what we call decision P&L, right? In actuality, when we really trade this strategy, you may get different price, right, which is indicated with the, again, dark blue P&L. And simulation trading, yet another one. We have a yellow price here, right? And moving on to the backtesting P&L, in this case, again, this is just totally hypothetical to demonstrate the potential of differences, right? This P&L is actually negative, right? So if you were deciding based on this type of trade, we'll say, well, actually, this is one trade, so you won't be deciding on the strategy based on one trade, but if this was a reoccurring phenomena, we would say, well, this strategy in backtesting is actually not profitable, right? Right, actually, in actuality, it could be profitable, right? So it kind of works both ways, right? You can be sometimes too conservative, you can be too optimistic. The point is we understand the source of these prices the source of these differences and how to avoid them, how to model them properly. Moving into another fuzzy picture, which is comparing the trade count dynamics. What we see here, and this was actually demonstrated in the previous example, was that, again, in simulation trading and actual trading, we can have two trades here, right? And because we are running in real-time prices, entry is true, exit is true, we enter, we exit. In backtesting environment, we can only trade in sequence. We cannot exit before the the entry is true, and because we are assuming that the orders are executing at the prices of the next bar, we basically missed one trade in the backtesting environment. So in backtesting, we would be assuming one trade, while in reality, or in simulation and live trading, we would be having two trades, and performance between these two trades would also be very different, right? So these were just kind of providing some examples of how these differences come into play. And again, they may be trivial if the strategy is low turnover, but they probably are fairly significant if we are talking about more high frequency strategies. So what are those backtesting limitations? I think the most significant limitation is the data structure, right? We are using sample data, and signal is therefore evaluated, and the signal is evaluated at the end of the bar, not on every trick, which can result in different trade count. Price movement is also not known. We don't know what the sequence of the price is. Typically, we're not trading just with one order, right? We have a market order for the strategy. We also have a stop order. We also have a limit order. And if we don't know what the sequence of the price is, we don't know which order gets filled first, right? So we could potentially exposing our backtesting to overfills, or we have to deal with it in some way, basically just work with one order in backtesting and then kind of test multiple orders in a different environment. So we can have only one trade per bar. We could possibly, if we have multiple trades, we don't know how to deal with overfills. When we trade with market orders, we're assuming they get filled at fixed prices, either open prices or the closed prices, which is really user specified. And again, there's some more flexibility by different vendors, but it's fairly limiting, right? And limit orders in backtesting are assumed to be filled somewhere within high and low range, but we don't know exactly when, right? And in addition, the fill rate is assumed to be 100%, which is not, or typically not the case in real life trading. We can either have more trades or less trades because we are not able to account for sudden price moves. We don't know how sequence of the prices is moving. Then again, changing the trade count. Model again is based only on trading data. We are not accounting for any bid and ask prices, so we are completely ignoring the spread cost. If backtesting is not using volume data, which a lot of vendors are not providing volume data, Quantopian does provide volume data, we are assuming 100% fill rate. If your order happens to be large, or larger than the volume that is typically traded for that particular stock or contract in a time period, again, you are underestimating market impact significantly with this type of backtesting environment. Slippage, as I mentioned, is incorporated in as a fixed rate in terms of ticks or cents, which is very simplified. It's typically not size dependent, and network latency is missing. So kind of recapping what we already said. So how can we improve this? One way is to incorporate intrabar price movement assumptions, right? Oftentimes these are vendor-dependent variables, but if you may have flexibility to do that, I definitely encourage. So, for example, if open price is closer to the higher price, we assume the price is moving high-low first, or other way around, right? This would allow us then to be able to backtest with multiple trades, with multiple orders at a time, because we know which one would potentially get filled first, and also we can potentially have more than one trade in a bar, which would then improve and bring backtesting closer to simulation and live trading. We can also use a hybrid data approach. So in addition to open high-low classes, we can incorporate bid-ask data selectively, only for the bars, maybe, where we know the signal is true. Or we can incorporate it, the bid-ask data in a way that would allow us to assume that prices get filled out of the bid on the ask, to at least incorporate the spread cost in our backtesting environment. Again, some platforms may allow you to do this easily, and sometimes you have to really do a workaround to get this accomplished. Typically, and ideally, we would always assume trade prices that are closest to decision price. So if you have an option between open and closed price, you would go with the open price, because the open is typically closer to when the decision happened. If you have possibility to incorporate signal price, price that is very close to the signal price, or then you should do that. I think using closing prices exposes you to a lot of timing risk and potentially excludes some backtesting strategies out of the pool that otherwise could have been profitable in real time. Always use limit order model that is conservative. So don't assume that limit orders will get filled out of the high or the low, but you assume limit orders get filled at limit prices or worse. Volume data, of course, always improves, especially for large order size strategies, so that you can fine-tune the market impact assumptions and limit your size as a portion of a volume that is potentially traded within the time period, and account for partial fills already in backtesting, because that for sure will happen in simulation trading. So what are the simulation trading limitations? So while signals are processed based on the tick data, which can either be done in real time or replayed, the fills are still assumed. And it's really up to the simulator to kind of give you the accuracy of your fill. And there can be very big differences between different simulators, how accurate they're trying to assume the fill happen or not. Also, what is important here that your simulation trading signal execution runs on the same data frequency. Some platform will say, well, we're going to be doing simulating trading based on the open signals are going to happen based on the open high-low prices, but executions happen in real-time prices. So then you have a mismatch between these two, and you can't really trust the execution price in this type of environment. So they have to be in sync, the signal processing data frequency and the execution data processing frequency. It's very important that the simulator is using level 2 data, and a lot of market simulators are not using level 2 data because you're really underestimating partial fills and partial fills, and market impact is extremely underestimated if level 2 data is not used. I think that the Interactive Brokers, which is the vendor, which is execution broker that is used by Quantopian platform, is not using level 2 data. So just be mindful of that when you're doing simulation trading on the little bit larger orders. So there, again, as I said, very big differences between different simulator, which are typically provided by brokers. Only very large shops, prop trading shops, are able to develop their own market simulators that are really specific to trading style and trading strategies that they are doing. So it's important for individual traders to kind of understand really what are the parameters that the simulation environment is working with. So order fill probability, which is the chances the order gets filled by a different simulator, is really a function of many different variables that work very dynamically together, and all of them are kind of together determine if order gets filled, how much of that order gets filled, and at what price. There are many different order types out there: market, limit, stop, hidden orders, iceberg orders, and some of them may be simulated, some may not be simulated. The easiest one is to simulate this market order. When it comes to limit orders, it's a little bit more complicated. Then we have pegged orders. So not all orders may be supported by your simulator, yet you may want to use them in your trading strategy. Order size is a big variable, of course. Larger orders, high probability to fill, a small probability to fill in one chunk, and smaller orders. With ask volume and market depth, have to take into account visible and hidden volume. There's a lot of hidden volume out there, which basically improve your market impact, and some simulators may not account, and it's sometimes not very easy to model the hidden volume on the order book. Trade volume and time of the day, very important variables, probably more easy to model. More difficult to model is placing queue. This really impacts the limit orders. Limit orders may get, not all limit orders may get filled, even if the price level that they are placed at is reached, right? If the order is in last in queue, it has to have many different orders to be, many different orders have to be executed before that one gets first in queue. Execution exchange is also a very important factor here that may be more relevant for equities than for futures. There are very big differences between different exchanges, how they process order, how they fill orders, what are the latencies associated with them. So something like if you send order to NYSE versus IEX, it's very different dynamics, right? That simulator hopefully should take into account. Latency, as we already spoke, typically is really not modeled in part of the simulator, but it can have a big impact on the execution price, or even missed trades dynamics. And overall market conditions are an important variable in determining the fill rate. So all of these variables kind of have to be part of the simulator. So it's something that it's difficult to model, and as you can, if you're not, it's impossible to replicate relative to live trading. So of course the differences are it will result in differences in our trading performance. Limit orders are particularly tricky because it's very hard to model the dynamics of how orders get actually filled in a limit order model. And again, big differences between exchanges. If you are trading futures, for example, a lot of future exchanges would provide market simulators that are mimicking live executions exactly. Then it's basically a replica of their live trading environment, but they will allow you to submit mock trades into that environment. This is not the case for equities. In equities, almost all simulators will have to be designed. So execution of, I would say, advanced order types can sometimes be quite different from what you get in live trading. What can we do? How can we improve the simulation accuracy? Use realistic limit order fill assumptions. There's many different ways you can assume limit orders get filled, right? Use the one that you think is most appropriate for your trading style. Market depth significantly enhances accuracy of orders fills, market impact, partial fills, all of the above. So you can always ask your simulator if they're using market 2 level or not. And if not, try to somehow add it. Whenever we are assuming fills in simulator, we should always work with the bid-ask data, with the quotes data, right? So looking in the orders should be matched with the bid or the ask, depending if it's a buy or a sell, not just looking at the trade size. That improves, again, the size, the market cost, the spread cost, and all, and the fill rate. Usage of transaction cost model is also very important, and a lot of vendors allow very high level of customizability in a transaction cost model. and ideally you would incorporate all the relative parameters there, not just some static, real kind of a relative volume model. Something that is probably worthwhile spending some time into researching, because that can have quite a significant impact on the trade performance, especially if the orders are large. And dynamic latencies models, there are certain vendors that are providing you to model the model latency in their platform. So again, that kind of is very subjective based on your network, where you are, and what kind of product you're trading. So something that definitely it's worthwhile thinking about, especially if your trading strategies are on the high frequency side. So how do these factors matter? What do they matter, actually, right? So I guess I've been repeating this through my talk there. We can kind of divide trading styles into three different categories, right? High frequency trading, intraday trading, and low frequency trading. High frequency trading really means your holding period is in milliseconds. You trade super fast. Latency is very important. Your expected profit is super small, less than a spread, and your order sizes are also very small. Your trading costs, you're very sensitive to the trading costs. So clearly, for this type of strategies, it's going to be very important how you model your simulation relative to live trading. Intraday strategies, holding period is minutes to hours. I would say expected profit is is multiple of a spread, or sometimes just spread itself. Order sizes are small. The cost of sensitivity is very high. So you want to be very careful how you model transaction cost here, and also make sure that your simulation environment is as close to real-time trading as possible, because it can have a huge impact on your trade performance. For low-frequency strategies, where holding period is days to months, your expected profits are fairly large, your order sizes are also large, the cost sensitivity is moderate, you would typically trade over more longer period of time, not just one bar as we're talking about here, but multiple bars. And your simulation and I would say environment is not as critical, because you may want to be assuming different order types anyway. So if you think about these different strategies, three different trading styles, how would you then pick your backtesting and simulation model, or a vendor, if you wish, right? Based on this division of trading styles. As I mentioned, in backtesting, it's really a backtesting and simulation model, one of the same. You can't decouple these two, because everything is so fast. You absolutely need level 2 data. You need custom-built simulator that only very large prop shops can afford. And your transaction cost model has to be very specific and focused on no small order execution, and latency is critical. For intraday strategies, you would want to use, I would say, sample bid-ask data to improve accuracy of your backtesting. And you also want to be using as much volume data as possible, and transaction cost model that is spread-based. Simulation has to be based on level 2 data. If you're just using level 1, I think you're going to be exposing yourself to a lot of risk in terms of timing, fills, market impact. So level 2 is important, and conservative limit order models and transaction cost model that is as realistic as possible. For low frequency strategies, you can, open high-low price usage of open high-low prices is probably sufficient. Orders are typically large; they take multiple periods to execute. So for this type of strategies, your simulation environment doesn't have to mirror live environment as closely as for the other two models, especially because this type of strategies you may want to be executing with the more advanced order types or execution strategies anyway, like VWAP strategies, arrival price strategies, or volume participation strategies. So you're not necessarily simulating them with real-time market data, but it's some kind of a advanced order type. So last but not least, what are the takeaways? Be very careful when you are picking your backtesting and simulation trading provider. Make sure that it really supports the highest level customizability that is really tailored to your trading styles. Know the nuances and pick data structure, fill models, and all the details that really match what you're trying to accomplish. Always look at your backtesting and simulation trading are working with consistent data. Level 2 data is critical in a lot of these things. And last but not least, you have to really understand the market structure of the trades of the market structure of the products that you are trading. There's huge differences between, say, futures and stocks, right? In futures, there's just one exchange, so smart order routing is irrelevant, more or less. Whereas in equities, really, that's one of the key factors these days, where your orders are executing. And if you're starting with this business, start with low turnover strategies, liquid trading universe, small order sizes, and be conservative, but not too conservative, so you're not excluding yourself from profitable trades. Questions? Any questions? No? For those who are still awake.
Can you take us through an example of a training strategy through the steps, like what we're learning there? Any simple strategy that you went through?
Well, I actually never quite traded out these design execution strategies, right? So I mean, like steps from from the how you thought about the model and then how you went on designing it.
I said design.
Well, let's just let's look at this particular one, right? It's very simple. It's a mean reversion strategy, right? So you start with the model, trying to figure out like what works and what doesn't. You run various optimization models to fine-tune the bands around your mean that you would want to be executing in, right? And when you are, with this particular system, design this in the backtesting. It's the transition from backtesting to simulation trading is fairly straightforward, right? We don't have to do a lot of changes in terms of modifying the system for the live trading, once put together the backtesting, we saw, well, these are the optimal bands, which are those two purple lines around it, right? Let's just see how it does in live trading. This one particularly just does market orders, so it's not really that sophisticated, right? But you may want to add some limit orders here, right? Or stop orders, making sure that, if it's not reverting to the mean, end up just losing infinite amount of money, but you stop yourself out of the losing money, so you may want to put some orders or type of, I would say, risk measures in there that if you're losing more than X amount of money, you get out of the trade regardless if it's profitable or not. Is that what you're looking for, or?
The description and the regimes change. How would you know that? How would you explain to yourself that this simple mean reversions that would not provide you the expected P&L? And then what would you do?
Well, okay. So yeah. So let's say, as I said, you run a back testing, and you say, well, this is great. You run it on many days, right? I mean, it's a 10-minute strategy, so maybe 3 months, 6 months should be enough, right? Out of sample tests, and you may want to pick different time periods, right? You may pick some, 3 months in 2009, and 3 months in 2010, and 6 months in 2011, making sure you have stability of the trading performance, so that not, the variability of performance is not large. And then I say, okay, let's just do next step is simulation trading, right? Let's do simulation trading, and meaning that, okay, now I'm going to be running this strategy in real time. I'm not going to be looking at just the open and close, but every tick price, right, and see how the performance compares. And I don't have examples here, but when I was watching this particular strategy, you notice that if it's not a mean reversion day, right, sometimes the stocks are trending for a long period of time, right, this strategy would clearly consistently lose money, right, because the mean would just keep going up, right? So you enter when your band is, let's say if you enter at this particular time, right, this particular time, and your signal is not true, you may exit at the point where you may have to exit at the point where mean is actually larger than your purple line, right? So you kind of have to watch for this type of events. And if your strategy is not dealing with this, right, you're going to be constantly losing money. You're going to enter trade, and 10 minutes later you're going to exit at a loss. You're going to enter trade, and 10 minutes later you're going to exit at a loss. So you have to put this into your strategy. So what kind of mechanism you put so that you will not actually enter this particular trade, or if you actually do enter, so you exit it in a time that would allow you to lose a minimum amount of money, right? So what can you do, right? I mean, ideally, you would have some kind of a predicting model that would tell you this is now no longer a mean reversion period, but this is now a trending period, right? If you don't have that model, then you can work with mechanistic type of measures, right? For example, every time you place an order to enter, right, immediately you put the stop loss order at the same time, which is a concurrent limit order at, I don't know, $100, $200, whatever your budget is, right? So this kind of mechanistic measures. Now, why do you pick 100, 200? Is this model driven, or is just some kind of arbitrary amount, right? Ideally, it would be model driven, but if you start from the beginning, maybe you want to try with different amounts, right? And as you are making changes, if you're thinking about all these changes, then you also put this into your backtesting system and see how does this change my P&L of your backtesting system. So it's a kind of a kind of trial and error, back and forth type of a process, right? And ideally, you kind of keep going with it and keep monitoring your performance in simulation trading until you kind of iron out all the kinks that you think would prevent you to make money with a strategy, or at least not lose money with a strategy, right? So I don't know if that helps. Yes.
So you mentioned some of the difficulties with the HFT style trade. I mean, especially in equities when you have multiple changes and the latencies between data centers.
Mm-hmm.
I mean, do you know of any HFT prop shops that actually do this type of simulation? I guess
all the prop shops have extremely sophisticated in-house proprietary simulators. They just can't survive without them. I mean, you can't. And again, for those kind of shops, and there are many, Citadels, Renaissances, right? Backtesting and simulation is one of the same thing, right? Because you're really working with such a short time inefficiencies. Oftentimes, these inefficiencies are actually technology-driven, right? Latencies, as you said, how quick your network is, connection is to certain exchange. Though I would say with all the buzz, negative buzz about HFT, I think the shops are becoming less and less reliant on this type of inefficiencies arbitrage, but they're really trying to work more with the actual, price-based arbitrage. So yeah, they would have to have their own trading simulators and environments where this would be, all the levels of sophistication would be available, various order types, various data, latency models, everything analytics-based, nothing, probably very little, based on rules of thumb or mechanistic rules, right? Yes?
On the trading side, how do you, after you get into the live trading, how do you monitor and evaluate your execution point? And how do you tune it up?
Right. So that's a very important step, and clearly I think also is maybe underestimated. Though if you're an individual trader and you're trading 3 markets, it's you just monitoring your P&L, right? I'm making money or not making money. So, however, if you're a larger institution, there's a lot of sophisticated platforms out there that allowing you to analyze transaction costs in many different ways. Starting with the expected alpha of the strategy to the algo selection, broker selection, venue selection, and various market dynamics details around order placement on a pin order and child order. you can use those tools. A lot of vendors are providing you with various transaction costs, like simple transaction cost analysis tools. I know specifically Interactive Broker does give users, individual users, and give a simple report as to how they did relative to various benchmarks. So this is what you want to be looking at, right? How I'm doing various to against my decision price, how are my trades performing relative to when I enter the trade, right? Am I constantly underperforming? I send a trade to, my broker at 10:05 and my trade gets executed at 10:07. Why did it took 2 minutes to execute? So you're going to be looking at the very different things. You want to be looking at the price relative to various benchmarks in the past. You want to be looking at the price relative to various benchmarks in the future, right? To see if there's any gaming or reversion or things like that going on. Average prices. You want to be looking at the time it took to trade. What exchange are you trading? Are you, is your broker biased against certain exchange, which in equities is slightly more difficult because of the trade-through rules, but in other exchanges may not be so irrelevant. So there's many different factors you should be looking at: time of the day, size of the order, various categories. And I can speak to you more about this after the talk because I see please end now lists out there. So if you have more questions, I'm happy to take it offline. Thank you.